Welcome to Strategy Saturday. I'm Charles Crillo. Today we're breaking down how to spot over-optimistic rent growth before it costs you real money, so let's get started. When an investment offering memorandum or a broker package is sent to me, one of the first things I always review is the current rents in place at the property and then the true market rent comparables. This delta in actual versus market rents is where the investor can protect their downside. If you are purchasing a property with $1,300 per unit rents and the market is $1,600, you have a $300 per month buffer. Problems arise when the current property's rent and market rent are very close, and the investor considering a value-add business plan where they'll be investing a large amount of money to upgrade the units and the property in general to increase the property's rents. Furthermore, in these situations, it's common for investors to become over-optimistic about future rent growth to make their underwriting pencil. This is what we want to spot early on. Over-optimistic rent growth is one of the most common ways multifamily deals look great on paper but often fail to materialize. Here are a few things we do to spot unrealistic rent growth. Number one is review underwritten growth versus historical market reality. So review the last 5 to 10 years of local rent growth. This is a mistake investors made in 2022. They relied on double-digit rent increases of the last 1 to 2 years and thought they would last, even though that was just a snapshot in time. Number two is avoid the standard straight line 3% rent increase. When I see this over several years in underwriting, I know the investor or broker just phoned it in and usually did no real research. The investor needs to dig into these numbers to see where they came from. Number three is renovation premiums without real proof. And this is a common trait among syndicators looking to raise capital for a deal or brokers looking to sell a deal. The underwriting shows that rents are well below market, and for the right investors willing to make some renovations, they can unlock hundreds of dollars in rent increases per unit. Any respectable underwriting pro forma like this will include some rent comparables, and this is where the work for the investor begins. We want to break down the comparables they list and find our own. A few of the ones we're going to be looking at is how close is the comparable property to the subject property? Are they the same vintage? I really like to see the comparable property being older than the subject property. Are the size of the properties and the amenities similar? How big are the units? How high are the ceilings? How is the parking? Find the comparable properties online and review the unit finishes. How well located are the properties? Yes, they are a half mile apart, but one is right next to a nice shopping plaza. Maybe one is on a busy street, while the other is next to a building in disrepair. Is there a highway, train tracks, water feature, like a lake, a pond, a river, or main road between the two properties? What type of commercial properties are located around each property? One property with a nice wine shop next door and one with a check cashing store will signal a difference in neighborhoods. What concessions or deals are currently being offered by each property to rent their units? Number four, ignoring new supply in the pipeline or coming online. New apartment supply disrupts rents for Class A, B, and C apartments. Class A and B are most affected, but this can trickle down the Class C apartments as tenants move up in class as new Class A properties offer fantastic move-in deals and concessions. Now, these concessions will quietly cap rent growth. Additionally, multifamily construction usually takes 24 to 36 months from groundbreaking to lease up, so it should not be any surprise to new investors that new units will be coming online. How many units are coming online over the next 3 years in your local area? For years with high deliveries, is the underwriting still showing that rent growth is happening? Number five is underestimated expense growth. If an underwriting model shows that rent growth will always outpace expense growth, look again. This is rarely the case, and expenses are usually harder to estimate than rents. Be wary of any underwriting model that assumes rents are increasing while expenses remain stagnant. Rent growth is hyperlocal. Yes, the market can give you a trend, but you really want to rely on only the comparables very close to the subject property with a similar vintage, condition, and amenities. It's important to understand that rent growth being just 1% or 2% lower or higher than your underwriting can have a massive change to the profitability of your deal. Another important point is that people with jobs and wages need to pay the rent. If rent growth is outpacing wage growth, or if other factors like inflation are squeezing local renters, it's going to make it that much harder to raise rents, and other landlords will start discounting rents to get people into their units. A trend that will continue throughout the market, eroding all rent growth. In multifamily investing, it's best to err on the side of conservative rent growth and rather focus on solid deal execution. If you're interested in learning how to raise rents without losing tenants, check out episode SS236. That's SS236. I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then. Have you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.